Hello all, welcome to the course on corporate law and governance. In this video, we are going to look at the company and its characteristics. In India, the companies were governed by the Companies Act 1956, but it was replaced by the Companies Act 2013. This happened in order to take care of the changes that happened in the economic environment, both at the national and at the international level. And the Companies Act 2013 came into existence mainly for the economic growth and development, and they were planning to achieve it by improving the corporate governance, by simplifying the regulations, and by strengthening the interest of the minority investors. If we look at this Companies Act 2013, it has 7 schedules, 29 chapters and 470 sections. This Companies Act 2013 is applicable to all the companies that were incorporated under the previous company law, the insurance companies, the banking companies, electricity generation and the distribution companies, and any company that got incorporated by any special act. Now let's see the meaning of the company. According to Professor Hannay, a company is an incorporated association which is an artificial person created by law having a separate entity with a perpetual succession and a common seal. From this definition, we can clearly see the features of a company. We can understand that the company is an artificial person. It has a separate legal entity and it has a perpetual succession and a common seal. When we use the term company, what we mean is a company that got incorporated by the Companies Act 2013 or under any other previous company law. Let's look at each of the features of a company. The first one is the separate legal entity. This separate legal entity, what it means is, here the company is distinct and separate from its members. Members are the shareholders of the company, they are the owners of the company. The company is different from its owners and the shareholders. The company can enter into a contract, can open a bank account in its own name, and it can have any transaction with any other individual, even with the members and the owners of the company. It can lend money, it can borrow money from other individuals and corporate. This concept of separate legal entity can be understood very well when we look at the most famous case, Salmon versus Salmon. This happened in the year 1897. Mr. Salmon was having a leather manufacturing company, and he converted his company into a limited liability company in the course of his business, and he was one of the major shareholder of the company along with his wife and his 5 kids. And he was also acting in the capacity of a secured creditor to the company. Because of some financial turbulence, the company got closed, and the unsecured creditors were asking for the money, and they went to court because Mr. Salmon was refusing to do so. And when they approached the court told that Mr. Salmon has every right to claim his portion of debt before the unsecured creditor because he is distinct from the company, or for that matter, the company is distinct from the member who is Mr. Salmon. So this case clearly indicates that the company is distinct and different from its members. The next feature what we have is the perpetual succession. Perpetual succession means the company will keep on existing even when the members cease to exist. In the sense that there would be changes in the members may die, the shareholding pattern may change in the company, but the company will still exist. This is called as perpetual succession, and the company can cease to exist only based on the legal grounds, not because of the change in the shareholding pattern or change in the members. For instance, we all know the company Bombay Dyeing. Bombay Dyeing is there, it got incorporated in the year 1879 and it still exists even though there are changes in the shareholding pattern and the membership. The next feature what we are going to look at is the liability. Here when we talk about the liability, we are talking about the liability of the members. The liability of the members vary depending on the type of company, whether the company is a limited company, yes, or if it is going to be an unlimited company or a company limited by guarantee. If a company is going to be a limited company, then the liability of the members is limited to the unpaid amount of the nominal value of the shares that the member holds. And this liability arises only at the time of the winding up of the company. If the company is going to be a company limited by guarantee, then the liability of the members are limited to the amount that is being guaranteed by the member in the memorandum of association of the company. And again, this liability may arise on the member only when the company is wound up, not during the course of the business. No one can be made liable for their portion. The last type that we are going to look at is the unlimited liability company. The term itself says the liability is unlimited. That means the member is liable for all the debts and the obligations of the company. Then again, this liability comes into the picture only when the company goes for its winding up. The next feature that we are going to see is the common seal. Common seal is the official signature of the company. It talks about the incorporation of the company. This common seal normally would be put in all the official documents by the employees as it is the signature of the company. But the Companies Amendment Act 2015 has made this common seal optional. In case a company wants to opt out of this common seal, then the authorization would be given by the two directors of the company or by a director and a company secretary of the company, in case wherever the company has appointed a company secretary. The next feature is the artificial legal person. A company is being created by the law and it is considered to be distinct from its members, and it has a persona, in the sense the company can, as we have already seen, that the company can enter into contracts, can borrow money, can lend money. Yes, the company can be sued and the company can sue others. But the company can, since it is artificial in nature, the company cannot be put behind the bars. The company cannot take oath or marry. and since it is artificial, the company needs someone to act on its behalf. Here, the director of the company will act as the agent for the company. So, I have been mentioning two terms here. One is the member, another is the director. So, we need to understand how the member is different from a director. When we see the member, who is a member? Member is the one who has invested in the company. Yes, and what are all the ways they can claim their membership with the company? One, by subscribing to the memorandum of the company, or giving it in writing that they want to become member of the company, or by holding the shares of the company. In all these three cases, an individual can become the member. In the first two cases, like the subscription to the memorandum of the company, or by agreeing in writing that they want to become a member of the company, their name would appear in the registers of members. In the last case, where they become the member by buying the shares of the company, here their name would be visible in the records of the depository. Then who is a director? Director, as I have already told you, director is the agent for the company who would be acting on behalf of the company for the reason that the company is an artificial person. And the director is responsible for managing the activities of the company. So, let us see the difference between the members and the director. First one is, who can be a director? The director, only individuals, only human beings can be the director. But then who can be the member? Individuals, any artificial legal entity like the company or a limited liability partnership or a government or a society can become the member. And what position that the director holds in the company? Director would be taking care of the activities of the business. But if we look at the members, members are the owners of the company who have invested in the company. Let us look at what are all the minimum number of members and directors that a company can have. In the case of the director, in the case of a private limited company, there should be a minimum of 2 directors and there should be a minimum of 3 directors in the case of a public limited company and a Nidhi company. Then how about the members? The minimum number of members in a company, especially with respect to the private limited company, is 2, and the minimum number of members in a public limited company and a Nidhi company is 7. The maximum limit of directors in any kind of company is 15, and the maximum limit of members in the case of a private limited company is 200, and it is unlimited in the case of a public limited company and a Nidhi company. A director cannot transfer his or her position to any other individual. So, that is not allowed. But a member or the shareholder can transfer their rights by selling their shares to anyone. Thereby, the rights get transferred. And only the director has the power to sign and authorize the activities of the company. Member cannot sign any document or authorize any of the activities of the company, but the member can attend the annual general meeting, can scrutinize the financial statements of the company. And when we look at the liability, the director is liable for any kind of non-compliance with any rules that the company is expected to follow. And if there is going to be break of any rule by the company, then the director is responsible for it. When we look at the liability of the member would be limited to the unpaid amount of the nominal value of the shares that are held by the member. So basically, a member is the owner of the company who has invested in the company, and director is the agent of the company and who is involved in the day-to-day activities of the company, who manages the affairs of the company. But one thing we need to know, that a member can also become a director. Next, let's get into the corporate veil theory. What is this corporate veil theory? This corporate veil theory deals with the first feature that we looked at, where a company is a separate legal identity, in the sense the company is totally different from its member. So in a way, it is good for the members for the reason that the members may not be in a position, or they will not be held liable for the actions of the company. In case the company gets into any kind of problem, the members will not be made liable for the actions of the company, as there is a feature which says that the company is distinct from its members. Yes, and can this corporate veil be pierced? Before we getting into the piercing of the corporate veil, let us understand what do we mean by piercing the corporate veil. Piercing the corporate veil means, here the court of law decides to do away with the feature of separate legal entity, and they make the members or the shareholders liable for the actions of the company. When they are going to put aside this limited liability, then we say that there is a piercing of the corporate veil. Now we are going to look at what are all the circumstances in which the corporate veil is pierced or lifted. The first circumstance that we are going to look at is to do with the character of the company. This character of the company means whether the company belongs to the enemy country. Normally, and this matters because transaction with the enemy company may put the interest of the nation in danger. So here the corporate veil would be lifted if the court of law finds out that the company is an enemy company. We will understand this better when we look at the case of Daimler Company versus the Continental Tire and Rubber Company. This particular case happened during the First World War. Continental Tire and Rubber Company was incorporated as per the company laws of UK, and it was incorporated in United Kingdom. This Continental Tire and Rubber Company was run by the Germans, in the sense all the members of or the shareholders of the Continental Tire and Rubber Company were Germans except one. And Continental Tire and Rubber Company were selling their tires to Daimler Company, and they have been doing that, yes. And on credit, all of a sudden the First World War broke out. So Daimler company refused to pay for the tires that it bought from Continental Tire and Rubber Company, stating that this may lead to trading with the enemy, as the shareholders of Continental Tire and Rubber Company were German. So Continental Tire and Rubber Company went to the court, and the court was actually determining the character of the company. If at all we are going to distinguish the identity of the company separate from that of its member, then it should not be a problem. But here the corporate veil got lifted because the court felt that though the company is distinct from its member, actually it is getting run by the members, and these members are all belong to the enemy company, that is Germany. And so Daimler company should not make their payment for the tires it bought from Continental Tire. In case it pays, then it may amount to trading with the enemy. So here if we see, the corporate veil got lifted. Next, let's look at another scenario where this corporate veil would be pierced. If a company is going to involve in an action to evade the taxes or to protect their revenue, then again this corporate veil would be lifted. We will understand this well by looking into this case of Dinsha Manekji Petit. This Dinsha Manekji Petit was a wealthy person. He was getting huge dividends and interest from his investments, and he had to pay a very high tax for the dividends and interest that he was getting from his investments. He did not want to pay that. He wanted to evade that. So what he did was, he started 4 companies and he bought the shares of these 4 companies with the money that he made from his investment by way of dividend and interest. Then after he started these 4 companies, he borrowed money from these 4 companies, and which he never paid back. If we see here, this 4 companies that Dinsha started did not have any specific commercial activity other than getting started with the dividends and interest of Dinsha Manekji, and other members also did not get any benefit from this particular company. So the court held that Dinsha Manekji has started this company only with the purpose of evading the taxes and to protect his revenue. So Dinsha Manekji was made liable for his action, where we cannot say that Dinsha Manekji is separate from the 4 companies that he has started. The next scenario where the corporate veil be pierced happens when a company tries to avoid its legal obligation. Let's try to understand this by looking at the case that happened between the workmen employed in Associated Rubber Industries Limited with the Associated Rubber Industries Limited. This Associated Rubber Industries Limited had shares with a company called Inarco, and they were getting very huge dividends from the shares that it had invested with Inarco. And what the Associated Rubber Industries Limited was doing was, this particular dividend that they were getting from Inarco were added to the profit of the Associated Rubber Industries Limited. This profit was used to pay the bonus for the employees of Associated Rubber Industries Limited. So that dividend, whatever they were getting, was huge. So as a result of which, the workmen were getting a very good bonus out of the profit. So after some time, Associated Rubber Industries Limited did not want to pay higher bonus to the workmen. So what the company did was, the company started a subsidiary and they named it as ARIL. They named it as ARIL. And what Associated Rubber Industries Limited did was, the Associated Rubber Industries Limited company transferred the entire shares of INARCO to ARIL, as a result of which the dividend that Associated Rubber Industries Limited was getting got totally stopped, and because of which the bonus that the workmen were getting got reduced drastically. So the workmen went to the court stating that the company has started a subsidiary with the sole objective of avoiding its legal obligation of paying the bonus out of the profit. And the court held that the subsidiary had been told that the judgment was in favor of the workmen, because the Associated Rubber Industries Limited company started its subsidiary only with the objective of avoiding the payment of higher bonus to the workmen, and the subsidiary did not have any other commercial activity except for the shares that got transferred from Associated Rubber Industries Limited company to this subsidiary company. So here again the corporate veil got pierced or lifted. The another circumstance in which the corporate veil is pierced or lifted, when a company starts a subsidiary with the objective of making this subsidiary to act as its agent. Let's understand this by looking at the case between Merchandise Transport Limited with the British Transport Commission. Merchandise Transport Limited had a difficulty in getting licenses from the British Transport Commission for its new vehicles because of some reasons. So what it did, like they are having a difficulty in getting license for their vehicles because they are applying in the name of Merchandise Transport Limited. So what they did, they started a subsidiary with the sole objective of getting licenses for their new vehicles. They started this new company, a subsidiary company, and they transferred all their vehicles to the subsidiary company, so that the subsidiary company can apply for license with the British Transport Commission, and in turn they can get the license. But the British Transport Commission refused to do so, because this Merchandise Transport Limited company and the subsidiary are one and the same. Yes, and the subsidiary, whatever that had been started, did not have any business operation but to get the license for the vehicles of the Merchandise Transport Limited, which is considered to be a kind of a fraudulent activity. And the court also was in favor of British Transport Commission, and here again the corporate veil got lifted. We cannot say that the members are distinct from the company. The last circumstance that we are going to look at is that corporate veil would be lifted if a company is formed in order to get themselves involved in a fraudulent activity or to defeat the law. Let's look at the case between Guilford Motor Company with Mr. Horn. Yes. This Guilford Motor Company appointed Mr. Horn as the managing director with the condition that Mr. Horn will not be soliciting the customers of Guilford Motor Company while he is going to be in the job as the managing director, or even when he is going to leave the company, he cannot engage with the customers for his own benefits. But Mr. Horn, he resigned his job after some time, and he started a company, a rival company, and he started soliciting the customers of Guilford Motor Company. If you look at this, and he made his wife and his friend as the member of his own company. And when Guilford Motor Company went to the court stating that Mr. Horn has violated his whatever obligation he had with Guilford Motor Company, yes, where he had signed a non-competing clause. He has signed it, despite that he is trying to solicit the customers of Guilford Motor Company. Here again the court made a judgment that Mr. Horn has violated, even though Mr. Horn is not part of the company that he has started, where his wife and his friends are the members. Still, it is very clear that this particular company is being created especially with the objective of competing with Guilford Motor Company and to solicit the customers of Guilford Motor Company. So here we do not have the distinction of the company from its member, and Horn was held liable for his action. Thanks for listening to this video.